Greetings to all, and welcome to the virtual launch of the 2026 Kearney Foreign Direct Investment Confidence Index. This is an especially meaningful version for us of this long-standing tradition at Kearney because it falls on the company's 100th anniversary. I am Eric Peterson. I'm Managing Director of Kearney Foresight's Global Business Policy Council and co-author, along with my colleague Terry Toland, of the 2026 FDI Confidence Index report. Thank you very much for joining this meeting. We believe that there are 47 countries represented on this webcast. We are delighted to acknowledge that we have with us today a number of senior government and business representatives, including members of our council's Global CEO Retreat community. Thanks also to our many Kearney colleagues on this webcast, starting with our managing partner, Bob Willen, and the lead of our Global Foresight Network, Per Hong, and GBPC senior fellows, Nigel Andrade, Nicola Lioliakis, and Eulalia Sanin. So before we share the findings of this year's report, I would like to review a few points on the structure of today's program. This event is on the record and will be available for viewing on the Kearney website after it concludes. For those of you wishing to join the conversation on social media, please use hashtag FDICI when posting about this content. Additional report details will be emailed to you at the conclusion of our meeting here today. We will close the discussions with a Q&A session, and should you wish to ask a question, we kindly request that you send that question to the host by using the chat feature in WebEx or reaching out to us via email to gbpc@kearney.com. We will collect the questions received and address them as best possible during the discussion. Please note that we may not have time to fully address all of them. I'm delighted to tell you that we will be joined today by esteemed Kearney colleagues Igor Hulak, Shirley Santoso, and Michael Zimmerman, each of which will share his or her insights and perspectives on our findings, following a brief presentation from me on the top line results. And I'll have the opportunity to introduce them more fully in due course. So now to main findings. As always, since its inception in 1998, this Foreign Direct Investment Confidence Index reflects the views of global executives making investment decisions. It is designed to capture forward-looking FDI intentions over the next 3 years, rather than to look at past historical flows. We would like to emphasize that this survey was conducted in January, which importantly was before the end February escalation of conflict in the Middle East. While clearly the world has changed as a result of developments, our results suggest that investors even then were anticipating some degree of turbulence in the year ahead. They identified rising geopolitical tensions alongside commodity volatility and political instability as the most likely developments this year. More broadly, our survey results reflect investor sentiment on how they plan to navigate this sustained uncertainty. So this year's report is titled World Recalibrating, and for good reason. That framing, as you will see, reflects what we see clearly in the data. My comments here will consist of 3 parts. First, I'll share our findings on investor sentiment and the broader global operating environment. Second, we'll walk through the rankings of this year, our global rankings, and also our emerging market rankings. And then finally, we'll cover key findings from our thematic section, which this year focuses on investor perceptions of industrial policy. And then we'll open the discussion to our esteemed colleagues. We'd like to begin here by emphasizing what is an important shift in this year's index. Technological and innovation capabilities rank as the most important factor influencing where companies are choosing to invest over the next 3 years. And this represents a meaningful change in the priorities that we've had over the years. In prior years, factors such as regulatory efficiency or economic performance tended to take the lead. And those remain important, of course, but they are no longer dominant. And what we see now is a clear shift toward innovation-led competitiveness. And this is really borne out in the data. Technological innovation is cited as the strongest reason to invest in 10 of the top 25 markets on our index. And this may be a reflection of the record levels of investments we are seeing in a whole range of emerging technologies, but of course, in particular, AI in several key markets. Turning to the global environment, investors identify rising geopolitical tensions as the most likely development in the year ahead. This is followed by increases in commodity prices and political instability in developed markets. And while investors may not have been able to anticipate the recent escalation of conflict in the Middle East, concerns about geopolitical risk more broadly were clearly top of mind. But what is striking is that as of January, investors suggested that they were not pulling back. Indeed, 88% of them indicated plans to increase their FDI over the next 3 years. Now, to the 2026 Foreign Direct Investment Confidence Index Global and Emerging Market Rankings. Developed markets continue to account for the majority of the index, representing 17 of the top 25 markets, although that is two markets fewer than last year. At the top of the rankings, the United States remains number 1 for the 14th consecutive year, supported by its leadership in technological innovation. As I mentioned earlier, that's such a critical element. Canada holds on to second place, continuing to benefit from strong fundamentals and its natural resource endowment. Japan rises to third, and China to fourth, reflecting a very strong showing from the Asia region. And Germany holds firm at the 5th place. Taken together, these results suggest that while investors still value the perceived safety and institutional strength of developed markets, they are also broadening the range of markets that they see as compelling destinations for capital. One of the most notable developments this year is in the regional context. The Asia-Pacific region claims the largest share of the top 25 markets for the first time in more than a decade. The region's strong performance is driven by a combination of technological strength, policy support, and long-term growth prospects. Japan, as mentioned, rises to third, with investors pointing to its technological innovation and targeted incentives, particularly in sectors such as semiconductors and advanced manufacturing. And also, as previously mentioned, China climbs to fourth place, reflecting continued investors' interest in its scale, of course, its role in global supply chains, and its technology and innovation capabilities. We also see growing momentum among so-called middle powers. These are generally markets that are neither great powers nor small states, but still exercise meaningful influence in international politics and tend to operate within global rules and norms. Singapore is a clear example here, making the largest jump of all markets on our index, rising from 15th to 8th place this year, and serving as a stable, strategically positioned hub in an increasingly complex geopolitical environment. And Thailand and Malaysia both re-enter the index, after having not been on the list since 2023 and 2014, respectively. This may reflect the continued role of China plus one supply chain diversification strategies. Investors are looking to these markets as manufacturing and production hubs supported by improving infrastructure, competitive labor markets, and integration into regional supply chains. Turning now to Europe, that region continues to have a strong presence on our index, though its shares declined somewhat this year from previous years. While Germany and France hold steady this year at 5th and 7th places, respectively, the UK drops from 3rd to 6th, and this drop may be attributable to some of the uncertainties surrounding the UK government's budget at the end of 2025. In the lower half of our index, 4 of the 5 remaining European markets, Switzerland at 14th, Spain 15th, Sweden 17th, and Denmark 23rd, either maintain or experience some decrease in rank year over year. While the decline of several European markets reflects growing competition in the rankings, we believe, investors consistently highlight European technological innovation capability, its economic performance, and talent, workforce talent, as key factors driving their investments. Now, to the Americas. The region remains anchored by the US and Canada at 1st and 2nd places, respectively. However, we did observe that net optimism on the broader 3-year outlook for the US did drop some 17 points year over year, while Canada's score, in contrast, increased by 2 points. The US position is underpinned by its leadership in technological innovation and resilient economic performance. Canada, as mentioned, is benefiting from natural resources stability and growing investment in AI infrastructure and other key technologies. Further down the rankings, we see Brazil and Mexico both moving up, reflecting efforts to improve ease of doing business and their positioning within evolving regional supply chains. And then finally, turning to the Middle East and Africa, both the UAE and Saudi Arabia rank in the top 10, reflecting strong economic performance, active government investment strategies, and ongoing efforts to diversify both their economies. Of course, and I wish to stress once again, it's important to note that the impact of the conflict is likely to weigh on near-term investment sentiment. And while much will depend on the scope and duration of the conflict, investors' perceptions of these markets in January reflected the fundamental strength of the economic systems. Specifically, they cited economic performance and ease of doing business as attractive reasons for investment. Now, I'd like to move to our 4th annual emerging market rankings. And we've already talked about a number of emerging markets in the context of the global rankings. But the Americas region, Asia Pacific region, and the Middle East and Africa each have seen 7 markets represented, while Europe has 4. The overlap on global rankings includes, of course, China, UAE, Saudi Arabia, Brazil, Mexico, Thailand, Malaysia, and India. This suggests that investors are evaluating opportunity in a more integrated way, and that some emerging markets are becoming central rather than peripheral to global capital allocation strategies. Our results this year show notable gains, as mentioned, for Thailand and Malaysia amid continued supply chain diversification. Other markets that make noteworthy gains are Vietnam and Peru, rising from 19th to 16th and 24th to 21st, respectively. Vietnam, of course, is positioning itself as a hub in Asia's semiconductor supply chain, investing in high-quality human resources. And Peru's 3-rank improvement may be attributable to the May 2025 launch of the deregulation package there to boost competitiveness and efficiency in the market's investment climate. Let me now turn to the thematic section of this year's report, which, as I mentioned, focuses on industrial policy. We chose this topic because of the clear acceleration we have seen in government intervention in recent years. Across regions, countries are deploying a wider range of tools, from subsidy support and tax incentives to tariffs and export controls to shape competitiveness and investment. And this clearly is not a marginal shift, as our data suggest. According to our partners at Global Trade Alert, new industrial policy interventions last year were more than 260% higher than in 2019. And this suggests a structural change in the investment landscape, one where policy is playing a much more direct role in shaping capital flows. And that brings us to how investors are responding. A striking 84% of them said that industrial policy is extremely or very important in determining where their companies make foreign direct investments. And more importantly, that's across the sectors represented by our respondents, from information technology to heavy industry to healthcare, reflecting just how broadly policy is shaping these investment decisions. We see this in practice across several countries. For example, in recent years, the CHIPS and Science Act in the US, the Made in China 2025, and the Green Deal Industrial Plan in Europe have all helped to catalyze investment into priority strategic sectors. 78% of investors believe that industrial policy enhances domestic competitiveness, but that positive view depends heavily on how that policy is implemented. Much of investors' risk sensitivity to industrial policy in the end is rooted to uncertainty. 79% said that frequent changes in industrial policy create uncertainty for their global investment planning. And therefore, predictability grounded in clear and consistent industrial policy frameworks is clear to sustaining investor confidence and strengthening industrial policy outcomes. We also asked investors how they view specific industrial policy tools. Infrastructure development is the most positively viewed tool, with 80% of investors agreeing that it is effective and 44% rating it as very favorable. 78% of investors view tax incentives as effective, second only to infrastructure development, with 41% describing them as very favorable. And Asia-Pacific investors show particularly strong support for subsidies. Roughly 80% of them in the region view the effectiveness of subsidies somewhat favorably or very favorably. By contrast, tariffs and export controls are viewed less favorably across the regions, reflecting concerns, no doubt, about cost, about retaliation, and about fragmentation of supply chains. Despite these complexities, companies express a high degree of confidence in their ability to contend with new industrial policies. 86% said that they were prepared to navigate industrial policy developments, and the data suggest a potential execution gap. 43% said that they were very well prepared to navigate industrial policies, as opposed to 16% who report below the sea level, who are on board or on the same point of view. So while confidence is high, ensuring alignment across organizations, we believe, will be critical in the years ahead. How are companies responding in practice? When asked how their companies are responding to the implementation of new tariffs, for example, investors pointed towards strategic and structural adjustments rather than blunt responses like raising prices. And the most common response is strategic foresight and scenario planning, which was cited by 37% of investors. Indeed, firms that embed this kind of strategic foresight throughout their operations will be best prepared to navigate these industrial policy shifts, as well as, we believe, other exogenous shocks. Our respondents also pointed to finding new suppliers and shifting investment to lower tariff markets. And these findings suggest that companies are not only reacting, but they are also redesigning their operating models to navigate a more complex trade and policy environment. So with those results now, I'm now going to turn to our panelists to ask some questions about their reactions to our findings. And after that, as I've indicated, we'll be opening things up to the audience for questions. So we begin with our colleague Igor Hulak, who is a partner based in the Middle East and global lead of our metals and mining at Kearney. Shirley Santoso is a partner based in our Indonesia office. And Michael Zimmerman serves as a partner in Kearney's New York office. Welcome, warm welcome to all three of you. Let me turn first, if I may, to Igor for his insights into investment trends in the Middle East. The conflict was certainly top of mind. Our survey, Igor, as you know, was completed in January before things escalated. How should we interpret the results, the very positive results for the Gulf today?
Thank you, Eric, and greetings to everyone from me from sunny evening in Riyadh, here in Riyadh. So, yes, let me start making the first point that I would make is methodological. And again, to remind that the survey was conducted in January 2026, before the outbreak of the current war conflict in the region. So these results are best read as a pre-conflict snapshot of the investors' intent, not as a live reading of wartime sentiment that all of us probably can read in the daily newspapers and the headlines of the news. The distinctions matter because it allows me to separate two parts or two truths. First, the Gulf's ranking in our 2026 Foreign Direct Investment Confidence Index is genuinely reflecting several years of hard work on infrastructure, diversification, industrial policy, and investors' confidence. Second, the current conflict has materially changed the risk environment. As all of us know, as of today, several weeks in the conflict, the media headline news educated many and reminded all of us around the world that the region and Strait of Hormuz remain centered to global energy and shipping flows, representing roughly 25% of the world's seaborne oil trade, with limited bypass capacity. So yes, investors will reassess the timing, risk, logistics, and insurance. The index, however, captured well-earned confidence before the shock. And the question now is whether that confidence can be protected through reliability, continuity, and disciplined execution, as also the results of our survey very strongly suggest, and you are just quoted them.
Thank you, Igor. That is such a critical set of points for us to take into account. And if you'll allow me to dig deeper a little bit, what explains the rise of Saudi Arabia and also the UAE, which did so well? What does the UAE's continued strength reflected in our survey tell us about investor priorities there?
Yeah, thank you for the question. And it's good to see both countries ranking so high on the Foreign Direct Investment Confidence Index. I see Saudi Arabia and the UAE as two complementary investment propositions. Saudi Arabia's rise from 13th to 10th on the 2026 index reflects scale, reform momentum, and the growing credibility of a long-term diversification agenda. The UAE held a firm ninth place, holding similar ranking but different underlying strengths. Its proposition is built on connectivity, business execution, and the ability to attract foreign capital even in a more volatile world. The broader confidence, in my opinion, and I believe the survey is an evidence of that, didn't appear by accident. Kearney's 2026 FDI Confidence Index shows up in also other benchmarks. In the World Bank's 2023 Logistics Performance Index, the UAE ranked 7th globally, Saudi Arabia 38th, rising from 55th positions. On the Global Innovation Index, it shows the same strengthening in the underlying conditions investors care about. UAE ranks 9th globally on infrastructure and 6th on policy stability for doing business. Saudi Arabia ranked 3rd globally on the state of cluster development. And at the zone more granular level, FDI Intelligence 2025 awards ranked Jebel Ali 2nd overall globally. So these are also other evidences of the sentiment that we saw in the survey. And allow me, with my industry hat on, also mention a few words about the mining, a third pillar of Saudi Arabia's diversification agenda. The transformation is even more striking. The kingdom broke into the global top 10 of the Fraser Institute 2025 Investment Attractiveness Index, ranking 1st worldwide in regulatory clarity, regulatory consistency, and taxation. And that reform has been converting into also the real capital. Exploitation licenses surged more than 200% year on year, achieving nearly 12 billion in committed investments. So the Gulf investment story is not theoretical. Although with the methodological disclaimer that we mentioned, it is increasingly backed by internationally benchmarked gains in logistics, infrastructure, business environment, and industrial platforms. So referring to my opening remark, I would not frame this as Saudi Arabia versus UAE. The two Gulf markets reflect two different but mutually reinforcing models. Saudi Arabia as the region's largest transformation platform, and the UAE as its most established global hub. And in the current environment, both still matter. The real question is how they preserve delivery confidence while geopolitical uncertainty remains elevated.
And if you allow me, Igor, let's. You also in your initial comments mentioned industrial policy, and of course, we zoomed in on that as our thematic section in this year's report. But it begs the question: are Gulf industrial policy efforts really translating? And were they in the lead up to the outbreak of hostilities? Were they leading into higher investment confidence by investors? And what do you think? I mean, obviously, apart from restoring stability and security in the region, what now needs to happen to preserve and rebuild that confidence, do you think?
Yes, and we saw it on the graph from the survey. You quoted and you explained some of the results. And yes, when industrial policy is practical, consistent, and execution-oriented, it matters very much. And our survey evidence also is clear. Industrial policy matters most to investors when it is clear, consistent, and the most positively viewed tools are infrastructure development and tax incentives. When you look at the investment across the Gulf countries, we are talking now also highlighting the two countries on the index, Saudi Arabia and UAE, the investment into infrastructure and the consistency on the incentives, industrial policy has been very much noticed by the investors. And also, I would describe the Gulf approach as a collaborative industrial policy. where the governments, sovereign investors, regulators, infrastructure providers, education system, and private capital are aligned around real value chains. And that really matters, that consistency and that orchestration. The numbers have been showing also on the real FDI inflows. And then when you look at the UAE, the inflows rose from 20 billion in 2020 to 45.6 billion in 2024. And when it comes to Saudi Arabia, even higher, from 1.6 billion to 15.7 billion. And it's not perfectly smooth upward trend year on year, but the direction has been very clear. More foreign capital has been committed to these markets, and the stock of FDI has grown significantly across all 4 economies of GCC. For energy, mining, metals, process industry, manufacturing, but also for services, that matters enormously. But the conflict changes the operating standard, and we shouldn't forget that. This is no longer only about attracting the new investments. It is also about protecting investment that is already committed. And Kearney's conflict scenario work is right to argue that in a structurally more volatile operating environment, reliability, consistency becomes the binding constraint. So my emphasis now, and concluding, would be very practical. The countries needs to keep permits and customs moving, needs to communicate directly with the committed investors, protect workforce mobility and supply continuity. They need to prepare for logistic contingencies, move quickly where freight, insurance, or corridors risk are now affecting execution. In this phase, I believe the region will be judged by the investors less by ambition alone and more by whether it can deliver under these pressures.
Thank you, Igor. And let me repeat in my introduction, I mentioned that Igor was global lead of metals and mining at Kearney, and we're doing super interesting work with World Economic Forum and in other areas now. So stay tuned for all that under your leadership, Igor. Thank you for that. Now, if we could turn perhaps to Shirley to learn more about the opportunities and challenges shaping FDI in Southeast Asia and other emerging markets there. Several Southeast Asian countries, notably Thailand and Malaysia, as I outlined in the report results, Shirley, rose in both the global and emerging market rankings. So as you look at things, what do you think is driving the foreign direct investment attractiveness of these markets? And thank you again, Shirley, for being with us.
Thank you, Eric, and greetings to everyone on the call from Indonesia. So it's very encouraging actually to see that 10 economies from Asia represented in the 2026 FDI index, and this is the highest share of any region. So if you look at the emerging market rankings, as you mentioned, Thailand improved its rank from being number 10 to number 6, and Malaysia from number 11 to number 7 in 2026. And if we look deeply in terms of what drove those increase in ranks, those are primarily driven by 3 things. The first one is ease of doing business. The second one is the skilled labor pool, and the third one is in terms of economic performance. So let me take an example of Thailand. So Thailand in 2025, the FDI rose by about 67%, and it has done a lot of things to improve the ease of doing business. And in fact, the government has been doing things to reduce the red tapes. And for example, if you want to start a business in Thailand, it has cut from 27 days to 4.5 days. It installed e-government system. It installs super license system, which is a one-stop applications for your business within 180 days. Apart from that, it has also trained its labor pool with lower costs compared to developed market in industries such as automotive, electronic, and food processing. And again, with China Plus policy, Thailand has benefited a lot. So again, I think we are seeing a lot more momentum for Thailand. And if you look at Malaysia, it's basically coming up as a strong high-value economy, focusing on services, technology with skilled labor. Last year, Malaysia has a record-breaking performance in terms of FDI. And some of the drivers include like skilled workforce, and this includes in high value industries such as electrical and electronics and semiconductor. Also in terms of ease of doing business, the government has done a lot of things in terms of development project, such as the Eastern Economic Corridor that focus really on the high-tech industry with a lot of incentive and infrastructure upgrades as well. And the last one is in terms of technological adoption, where Malaysia is very good in terms of adopting and scaling up, as well as advancing the manufacturing technology in areas such as semiconductor, back-end electronics manufacturing, as well as data center.
That's so critical. Thank you. And as we look at the vulnerability of the region now on energy and oil price volatility arising from the conflict in the Middle East, how do you see oil supply and pricing challenges, Shirley, in terms of its impact on regional growth and sentiment of investors?
Yeah. Oil shocks definitely from Middle East conflict has hit Asia broadly and quite fast, because most of the economies, if you look at Asia, are net energy importers, and in fact 60 to 70% of Asian oil come from the Middle East. So I think in terms of the result, it's really a chain reaction, and again, some are shorter term and some are longer term. In terms of the shorter term, of course, you will have a higher cost in terms of inflation, especially for countries like Indonesia, India, and Philippines, where your transport and logistic become a lot more expensive, and we have also higher electricity costs, especially in terms of oil or LNG reliant countries, as well as increasing manufacturing costs, slower growth, and also fiscal strain, especially in certain countries that subsidize fuel, and of course, more cautious investor. So again, shorter term, there's volatility, there's cost pressure, and also supply chain disruption. However, I think in terms of the medium term, this conflict has also reshaped the investment patterns, and I guess the agenda towards more energy independence in some of the countries, even if you look like Malaysia or Indonesia, and more resilient growth model become a lot more important. And again, I think if you look at some of the countries like Malaysia, where they are also energy producer, in certain extent, they also benefited. And in some countries where you have a lot of strong reserve, energy reserve, like in Japan, or energy resilience like China, they are also benefiting. And again, countries like Indonesia with its commodity and EV ecosystem will benefit in the longer run. So again, I think medium term, we see that, potentially this can open up to more FDI, and some of the countries that have natural resource could also benefit from the commodities revenue as well. Thank you.
Thank you, Shirley. And if we could follow up too on a point that you raised earlier about talent and skill of the local labor pool. As you highlighted, that was one of the key elements that investors cited for the region as a whole, notably in India, Vietnam, and Philippines. And so as we look forward here, as we think about the 3-year scope of we challenge respondents to think about business leaders. How do you see countries across the whole region fostering that local talent and meeting future workforce skill demands?
Yeah, I think what we are very encouraged to see is that across the Southeast Asia country, government and companies are very kind of like intentionally building this talent pipeline to match what investor and industry needing, especially like when you look at manufacturing, technology and services. So again, I think if you look at the last few years, there have been a lot of reform in terms of education, industry partnership, as well as a very kind of targeted upskilling program. So Vietnam, for example, they've expanded their technical and vocational education that tied to their strength in terms of electronics and manufacturing. Again, India is very strong in terms of promoting the engineering and IT education, digital at a more massive scale. Philippines, for example, they emphasize more on the business, some healthcare, and also English-based services. And the other thing that countries have been doing is also to expand their technical and vocational and education trainings. Again, an example of that is Indonesia, who are heavily expanding into TVET to really support the industry. And lastly, I think digital and tech upskilling is also very key to all these countries to improve in terms of productivity and also AI as well. So again, countries like India, who are best known for high-tech skills and global services, as well as countries like Malaysia in terms of doing coding bootcamp, online platforms, scaling to access to training are some of the things that have been done by some of these Southeast Asia countries to really accelerate in terms of their digital and tech upskilling. Thank you.
Thank you. And Shirley, we've had a question from our audience that maybe puts you a little bit on the spot, but as all predictions do, but it asks, looking ahead in terms of the markets across the region, which are most likely to climb to the top 10 in the next few years? Are there any that you expect that will really grow rapidly? I know that that means kind of calling out preferences, but what do you think?
Well, I guess I mean I would agree with some of the FDI report that countries. I think it's very important to see the intent of the country and also the structural reform. So I think if and I would I guess separate between the developed market versus the emerging market. So emerging market like I would say Thailand, Malaysia. Would still and Vietnam continue to do best. Countries, however, like Indonesia, I think can also have the potential to increase. I know that this year they dropped from 12 to 13, but again, I think if we look at the longer run, if they can do secure the energy supply, to look at a more diversified, energy base and also leveraging their mineral richness as well and doing some structural economic reform. So hopefully they could also increase their rank. But if we look at the more developed markets, so countries like Japan, Singapore and China, I would say that they will still be able to maintain their rank in the top tier, top 10, because of their stability in terms of the economic policy, their longer term, especially in China, if you look in terms of the resiliency and the structural of their economic policy is really, really good. So this country, I would say, and Singapore, of course, in terms of ease of doing business, this country will still remain at the top of the FDI index.
Makes perfect sense. Thank you. Now let's turn, if we can, with thanks to you, Shirley, for all those valuable comments, to Michael for his thoughts on industrial policy, supply chains, etc. And if you haven't seen it, you must. Kearney does a thing called a global logistics report, State of Logistics. And Michael leads this, and it's a remarkably useful document every single year. And he's well advanced in putting together this year's version of that. But Michael, just kind of generally speaking, what's your point of view? How are companies responding and reacting to the kind of industrial policy issues highlighted in the FDICI? And what examples have you seen among your clients on this? It'd be great to hear from you on that, and thank you for joining us.
Pleasure to be here, Eric, and thank you for making logistics and supply chain focus part of the conversation. What I've seen, and the findings in the index confirm it, is that company responses to industrial policy, tariffs, they've been concentrated on scenario planning and optionality creation. And consequently, you see this in the index as well, the diversification of product and materials sourcing and routings. Companies have had to adapt. You get disrupted, you get shaken up, you adapt. And Shirley said it about countries in Asia around energy. Here more generally, when these policies are disruptive, companies have to adapt or die. So that means that China +1 has mutated to China +2, +3, +4, and that's been healthy. The new sources that companies have been working with have created optionality, and then more competition among those sources. Sometimes you have to be forced away from your incumbents. And so that means that both the sources and the routings, the trade routes that are used by shippers have been diversifying and changing. So the merchandisers, those are the people in retail that buy the goods, and manufacturers who are buying raw materials and parts, supported by their procurement and logistics teams, are now more productive because they've been thinking more strategically, they've been getting more efficient tools, they've been investing in better visibility, and looking to create better supplier relationships. So both those that make things for them and ship for them. So there's been a tremendous outreach into the supply chain partner community to create that kind of optionality that's become necessary. So there's been a lot of scrambling. When you get a liberation day or a war that spikes oil, it's everyone at their stations. But they've gotten better at preparing and adapting. So tellingly, redesigning products to limit tariff exposure, which is hard to do, ranks 5th. And raising prices, as you pointed out, is dead last at number 12, because companies know that actions to increase flexibility and lower costs gives them more power, while simple price increases hands market share to more agile competitors.
It's apropos that point, Michael, that we use that word recalibration in the title of this report. And we've had a number of questions from our colleagues about that recalibration, the nature of the recalibration and also the duration of the recalibration. Is it short-term or longer range? And I'd like to invite all three of you perhaps to think about that a little bit. Maybe we could end on that point if we could just get short ideas from you on that. But Michael, when we talk about the companies overwhelmingly indicating that they're ready to navigate this complexity of industrial policy, very few of them signal the kind of vulnerability. And there are a couple questions on this that have come out. And what's your sense? Do you think that this sense of preparedness is well-founded, or are they perhaps more vulnerable than they may think they are?
Yeah, at first I thought there was overconfidence, right? But as I spoke with supply chain leaders and I reviewed the projects we've been doing with clients over the last 5 years, I found a more nuanced tale. Think of it as self-fulfilling overconfidence, in the sense that the supply chain leaders and actors in these companies have had so much thrown at them. I mean, think of what happened during COVID, during previous tariff events. We've had natural disasters. They've come to see that reliability and predictability can't be counted on, and they have to adapt or be punished. This is kind of how capitalism works again, right? So recalibration means that if your instruments aren't aiming the right way and aren't doing what they need to do under the circumstances that are constantly moving, you need to recalibrate. So initially, disruptions drove very painful cost increases, missed shipments, stopped production, high tariff payments, high inventories, angry customers, and market share losses, right? Capitalism has survival of the fittest at its core, and the companies in action today and the supply chain actors in them, they're much more battle tested. So I think that's where that confidence is coming from. It doesn't mean that they've gotten there in terms of resilience and agility that they need. And the teams in them are still too often scrambling, but they keep getting better. And I think that's where that confidence is coming from.
And on those good points, maybe we could ask you to respond to that question that's been raised with respect to duration of recalibration. Is this temporary? Is it transitory? Or is it structural and systemic? Yeah, what do you think, Michael?
The latter. I really like the word structural and systemic. I think that there have always been disruptions ever since commerce and supply chains and economies existed. But the rate of disruption has increased. Insurance companies have studied this, and I think we've all come to realize as participants in the global economy that this is structural and persistent. And ignore the evidence at your peril is what I would say. So the leading companies that I've seen have largely concluded that predictability and reliability are a thing of the past, and that they have to train their teams and their supply chains and their capabilities to be structurally resilient. Everyone talks about resilient, but after you've been resilient, which is defensive in a sense, you can absorb blows. You have to be agile. You have to be able to move quickly and take advantage of that disruption, because if you don't, someone else will.
Great. Shirley, what would you like to add to that in terms of the short-term versus long-range impact?
I guess, I mean, short term, I think this whole situation actually teach country in terms of how they should prepare themselves better. I think in terms of, they need to think about different scenarios as they are figuring out their strategy. So again, I think fluctuation, volatility, resiliency, I think is something that all the countries are experiencing. And so how do you make sure that moving forward in the longer run, in the medium term, you can be a lot more stronger, whether it's fiscal, investor attractiveness, economic performance is something that I think a lot of countries are learning a lot more in a faster way. So again, I think these are some of the lessons learned. And again, countries that some of them are doing a lot better, and you can see them in the rank already, like Singapore or Japan or even China. So there are a lot of things I think that different countries can learn from those countries how to be a lot, prepared in the longer run.
It makes perfect sense. And Igor, a last word to you on this. If you could just kind of briefly tell us what you think.
Eric, great discussion. I'm in the camp of those who are advocating that this is not a short term. This is with us for long term, as Michael also mentioned to you. This will last, whatever it is, however we call it. It will this recalibration. It's going to last for long. However, what I believe is that what the investors, and we are talking about the investors' confidence, are looking for is the consistency, how the countries will be tackling this recalibration, and whether they can rely on them in the execution. That will matter more than ambition, than the proclamation, and that will be judged by the investors. That's my belief.
Well, sincerest thanks to all three of you. The award goes to Shirley, of course, because it's so late at night there now, and then to Igor, and then Michael and I are kind of at more normal time zones here, but deeply appreciative to all three of you for your insights. It really fills out these discussions. And unfortunately, we've come to the end of our time here. This always happens. I always feel like we could go on much longer than we do, but in any event, let me conclude here by thanking our three panelists. And I'd also like to extend sincerest appreciation to my co-author, Terry Toland, and to Gabriella Werner and Kathleen Harrington of the GBPC for their very important contributions to this year's index, as well as to Alison McDougall and Sienna Warshawski for their excellent organization of this event. So with that, exactly on the hour, ladies and gentlemen, I'd like to thank you for joining us today. I'd like to also remind you that you'll be getting details of the report momentarily. And with that, and with sincerest thanks to all of you for joining us, that concludes our program for this year. Thank you to all.